Welcome to the Winthrop Wealth 2022 Market Review and Outlook. I'm Andrew Murphy, Co-Chief Investment Officer. 2022 was a difficult year for most asset classes, with both the U.S. stock and bond markets down double digits. We expect drawdowns like this to occur in the equity market every few years. What was unprecedented was the decline in the bond market. The U.S. investment-grade bond market had by far its worst year on record, going back to inception of the index in 1976. Today I'll go over key factors driving markets, as well as both our short and long-term outlook as we move into 2023. At Winthrop Wealth, our total net worth approach, which combines comprehensive financial planning and investment management, is designed to help our clients navigate through these challenging periods. These times can be scary for people who don't have a plan. We believe we can make the biggest difference for our clients when markets are volatile or when the environment is changing. We want to remind everyone that we are here to help. So if you have friends or family members that are asking you questions or are nervous about what's going on, we are pleased to act as a sounding board for these conversations. There is no obligation to become a client, but if they are important to you, they are important to us. And we're happy to speak with anyone who may have questions or concerns. Now we'll get to the video. The S&P 500 decreased by 18.1% in 2022, which was the worst annual decline since 2008's minus 37%. The market did close on a positive note with a 7.6% increase in Q4. This was especially welcome after 3 consecutive negative quarters to start the year. The S&P is, however, still in bear market territory, which is a decline of minus 20% on a closing basis without a subsequent 20% increase. After reaching a year-to-date low of minus 24% on October 12th, when the index closed at 3577, the market is up by nearly 8% since then. The decline this year was primarily due to the highest inflation levels in decades, which caused the Fed to aggressively tighten monetary policy and interest rates to substantially increase. The Russia-Ukrainian war and China's zero-COVID policy also helped exacerbate inflation and volatility by damaging supply chains and putting further upward pressure on commodity prices. If we look under the surface at the 11 sectors of the S&P 500, growth sectors, which were negatively impacted by the rise in interest rates, were hit the hardest, including technology, consumer discretionary, and communication services. While energy stands out as the main bright spot, with an increase of over 65%. This was mainly due to the rise in oil prices, which caused the sector's earnings to rise by an estimated 150% this year. The Bloomberg Barclays U.S. Aggregate Bond Index, or the AGG, which acts as a proxy for the investment-grade bond market, decreased by 13% in 2022. This was by far the worst calendar year on record since inception of the index in 1976. Prior to 2022, the worst calendar year performance for the AGG was minus 2.9% in 1994. Bond prices move inversely to interest rates, and the increase in the 10-year Treasury yield this year from 1.51% to 3.87% caused the decline in the bond market. Our objective with fixed income is to provide ballast, stability, and income to portfolios. Ballast means that ideally, the fixed income holdings are increasing when equity markets are declining. Bonds did not provide ballast this year as interest rates increased, but all else equal, the fixed income markets need yields to stabilize from these levels to achieve positive returns. We've stated this viewpoint for several months now, and will highlight that in the fourth quarter, the 10-year Treasury yield ended close to where it started with an increase of only 4 basis points, while the AGG index increased by 1.9%. Also on a brighter note, the bond market's yield to maturity, or the estimated rate of return an investor can expect from a bond if purchased today and assuming there are no defaults, ended the year at 4.7%, which is the highest level since 2008. Now we'll look at the primary issue driving markets, inflation. While most readings have decelerated from peak levels over the past few months, inflation is still far too high. The Fed has divided inflation into 3 buckets. Goods, where prices are coming down as supply chains normalize. Housing, which is decelerating under rising mortgage rates, but this probably won't show up in official inflation data until mid-2023. And non-housing related core services, which are still elevated due to the strong labor market and increase in average hourly earnings. The Fed is working to bring inflation back toward 2% by tightening monetary policy through raising interest rates and shrinking the size of their balance sheet. The FOMC raised the federal funds rate by 4.25% total in 2022, the largest net calendar year increase since 1975. The top end of the federal funds rate now stands at 4.5%. The FOMC's most recent summary of economic projections showed that the median participant expected the federal funds rate to peak at 5.1% in 2023. The Fed's pivot toward ultra-restrictive monetary policy has been jarring for the economy and a main reason for weakness in both the stock and bond markets. Just 12 months ago, the Fed predicted that the federal funds rate would end 2022 at less than 1% as transitory inflation rapidly decelerates toward their 2% target. The Fed got the inflation trajectory wrong, and they spent the year trying to catch up. And as we'll talk about in our outlook, near-term inflation readings will decide how the Fed adjusts monetary policy from here. And now for our outlook. 2022 was one of the most difficult investment environments since the global financial crisis, and we suspect that we're not out of the woods yet. So we've separated our outlook into short-term, measured over months, and long-term periods measured over years. In the short term, markets will likely remain volatile as investors debate whether inflation will fall fast enough to avoid a severe recession. If inflation either increases or stays elevated, the Fed will keep aggressively raising interest rates, likely causing an economic recession, further cuts to earnings estimates, and extended downward pressure on most asset classes. If inflation continues to moderate, the Fed can stop raising rates, and investors will begin to look forward to 2024 economic and corporate earnings growth, which currently appear a lot brighter than 2023. At some point, this more optimistic scenario will likely occur, although the first few months of the year might be especially rocky, as we really don't expect to have a definitive answer on inflation and the economy until the spring or summer. Over the long term, we suspect this difficult economic environment has created a strong opportunity for investors willing to live with some short-term discomfort. To demonstrate that premise, the following chart utilizes S&P 500 month-end data from 1940 to 2021 and shows that investing when the index is down more than 10% from the all-time high has produced both strong annualized returns and a high percentage of positive outcomes. We still believe those who are able to either stay invested, rebalance, or add to their existing holdings will eventually be rewarded. We're also still stressing the value in maintaining a long-term viewpoint and disciplined approach. And we are continuing to rely on our time-tested process while looking for opportunities to tax loss harvest, reposition and rebalance portfolios, and selectively put money to work for clients that have recently made contributions to their accounts. Thank you for watching today's video. And please visit our website at winthropwealth.com to view our latest commentaries.